The truth is this: right now, the currency market is nothing more than a sideshow to those markets that can't get enough breaking records on a daily basis. US equities and Bitcoin is where all the attention is at the moment, and as much as these two asset classes may seem like they're worlds apart, we're not convinced. Central bank policy accommodation post-global financial markets crisis of 2008 has ushered in the birth of the spoiled investor, an investor who believes the downside risk to their position is in not taking it at all. There's only up. Of course, this is a direct product of that central bank and government stimulus, and if stocks can rally with a complete immunity to downside risk, why should this mentality of riskless investment in risky assets not have extended to Bitcoin? But there is risk out there, and these markets are not immune. The winds of monetary policy normalization are sweeping in, and the rally we've been seeing of late has the feel of a rally getting all it can before that day of reckoning comes. But for now, the currency market is sitting back. Overall, the US dollar is looking increasingly vulnerable against the major currencies, while the commodity currencies and emerging market FX are getting pulled between the US dollar outflows on one side and worry about a possible liquidation in risk assets on the other. The pound continues with its credibility campaign in 2017, relatively outperforming despite a wave of US dollar demand this week from solid US data and a Fed outlook that may not be as dovish as the market thought. The Brexit build agreement is another achievement that further encourages the UK currency's prospects going forward. Meanwhile, the euro is holding its own, and despite a little more weakness, got some supportive news in the form of a hotter German inflation data today. Elsewhere, gold was a victim of some US dollar demand, while oil was apprehensive into the OPEC meeting. Looking to Thursday, key standouts come in the form of Aussie building approvals, China PMIs, German retail sales, German unemployment, Eurozone unemployment, Eurozone CPI, U.S. initial jobless claims, U.S. personal income and spending, and the personal consumption expenditure deflator. That's all for now.